October 29th, 1929. Black Tuesday, the day Wall Street died. While America watched $14 billion vanish into smoke, fortunes evaporating, dreams shattering, lives ending, one man smiled. Albert H. Wiggin, president of Chase National Bank, the institution millions trusted with their life savings, had just made $4 million. Not by accident, not by luck, by betting against his own bank. Imagine you run one of America's 3 largest banks. You sit in boardrooms with presidents. You live in a Fifth Avenue mansion. Depositors believe you're their guardian angel. And while publicly urging Americans to buy, privately, you're shorting your own stock, positioning to profit from the very collapse you helped engineer. How did he get away with it? More importantly, why did almost no one go to jail? This is the story of greed, betrayal, and the laws born from America's darkest economic hour. Picture New York City, 1927 to 1929. Skyscrapers pierce clouds. Jazz spills from every speakeasy. Flappers dance to Charleston until dawn. Factories churn out cars by the million. Radios bring entertainment to every home. America isn't just living the dream. It's inventing new dreams to live. Take Sarah Jenkins, a 34-year-old schoolteacher from Akron, Ohio. For 8 years, she'd scrimped on a $1,200 annual salary, saving $300 yearly. By 1928, she'd accumulated $2,400, a fortune to her. Her local banker smiled warmly. Miss Jenkins' Chase National Bank stock is as safe as a U.S. Treasury. Better, actually, it pays dividends. Sarah hesitated. The banker leaned in. We can loan you $5,000 at just 5% interest. Buy 18 shares at $280 each. When they hit $400, and they will, you'll have made $2,160 profit. Enough to buy that house you've been dreaming about. Within 6 months, Chase hit $620 per share. Sarah's $7,400 investment was now worth $11,160. On paper, she made $3,760, more than 3 years' salary. She wasn't alone. Barbers, farmers, widows, even children traded stock tips at school. The Dow Jones Industrial Average had rocketed from 63 in 1921 to 380 by September 1929, a 500% surge that convinced America poverty was extinct. At the top of this golden pyramid sat men like Albert Wiggin. At 59, he ruled Chase National Bank like a monarch. The bank operated 850 branches, managed billions in deposits, and paid Wiggin $275,000 annually, equivalent to $4.8 million today. His bonuses alone exceeded small-town mayors' annual budgets. He sailed on yachts, summered in the Hamptons, dined with the Rockefellers. Chase's investment arm peddled stocks and bonds door to door, earning fat commissions. The bank loaned billions to speculators through margin buying, purchased $10,000 in stock with just $1,000 down. The rest borrowed. If prices rose, you won big. If they fell, well, nobody imagined they'd fall. General Motors, Radio Corporation of America, U.S. Steel, corporate titans seemed unstoppable. Banks like Chase financed their expansion, collected interest, and sold their securities to an eager public. The financial sector employed hundreds of thousands, creating a self-reinforcing cycle. Banks loaned money to buy stocks. Stocks rose. Banks loaned more money. President Herbert Hoover declared in 1928, "We in America today are nearer to the final triumph over poverty than ever before in the history of any land." The Federal Reserve watched nervously as speculation spiraled, but when they raised interest rates slightly to cool the market, bankers like Wiggin pressured them to back off. Treasury Secretary Andrew Mellon assured Americans' economy was fundamentally sound. Why spoil the party when everyone was getting rich? Government revenue soared from corporate taxes and high employment. Politicians campaigned on prosperity. The 1920s boom felt eternal, unstoppable, divinely ordained. By summer 1929, those paying attention saw fissures. Farmers have been suffering since 1925, crushed by overproduction and falling crop prices. Factories accumulated unsold inventory. Americans couldn't buy goods as fast as assembly lines produced them. Britain's economy wobbled after abandoning the gold standard. Construction spending peaked in 1928, then declined. Bank failures in rural America doubled between 1928 and 1929. Smart money began quietly exiting. Joseph Kennedy, father of the future president, famously sold his entire portfolio after his shoeshine boy gave him stock tips. When even the shoeshine boys are giving stock advice, Kennedy allegedly said, "It's time to get out." Albert Wiggin saw it too, but instead of warning Americans or preparing Chase for turbulence, he did something audacious. He bet against his own bank. Starting in September 1929, through secretive family corporations named Shermar, Mullen, and others, some registered in Canada, to dodge U.S. taxes, Wiggin shorted 42,506 shares of Chase National Bank stock. Short selling is a bet that prices will fall. You borrow shares, sell them at today's high price, then buy them back later at a lower price, pocketing the difference. If Chase stock collapsed, Wiggin would make millions, while the depositors who trusted him lost everything. He wasn't alone. National City Bank's president, Sunshine Charlie Mitchell, publicly proclaimed confidence while privately selling his own shares. Executives at brokerage firms dumped stock while assuring clients to hold steady. Meanwhile, Sarah Jenkins bought more Chase stock on margin, borrowing another $3,000. Her total debt, $8,000. Her holdings, 28 shares were $17,360 at peak. She dreamed of retiring at 40, buying her elderly mother a home, traveling to Europe. The crash was 3 weeks away. September 3rd, 1929. The Dow peaked at 381.17. What followed was a masterclass in denial. Margin debt exploded to $8.5 billion, equivalent to 10% of America's entire GDP. Banks loaned to anyone with a pulse. A blacksmith in Pittsburgh borrowed $15,000 to buy radio stocks, convinced he'd retire rich by Christmas. A widow in Boston invested her late husband's $10,000 life insurance policy in safe bank stocks after a broker assured her they never go down. Investment trusts, precursors to mutual funds, multiplied like rabbits. Goldman Sachs launched the Goldman Sachs Trading Corporation, which raised $100 million from public investors, then used that money to buy shares in other investment trusts. It was financial Ponzi scheme masquerading as sophistication. By October, some trusts traded at 500% premiums to their actual asset values. Ordinary Americans quit their jobs to trade stocks full-time. Brokerage houses opened boardrooms, where spectators gathered to watch ticker tapes, cheering or groaning as prices jumped. It was entertainment, gambling, and economics rolled into carnival spectacle. Banks competed to loan more. Chase National, under Wiggin's leadership, extended $1.7 billion in margin loans by October 1929, money that would evaporate when stocks crashed. National City Bank loaned $25 million to its own executives to buy company stock, creating circular debt that existed only on paper. Corporations issued stocks at dizzying rates. New companies with zero revenue went public and saw shares quintuple in days. Established firms split stocks 5 for 1, 10 for 1, creating illusion of growth. Radio Corporation of America, which had never paid a dividend, traded at 505 times its asset value. The financial press cheered every milestone. The Wall Street Journal proclaimed new era of permanent prosperity. Economist Irving Fisher, America's most respected economic voice, declared on October 17, 1929, stock prices have reached what looks like a permanently high plateau. The Federal Reserve faced impossible choices. Raise interest rates to cool speculation? That would hurt legitimate business. Lower rates? That would fuel more gambling. They chose paralysis, watching nervously as debt pyramid higher. President Hoover privately worried but publicly projected confidence. His administration believed markets self-corrected. Regulation was un-American. Andrew Mellon, one of America's richest men, and Hoover's Treasury Secretary, believed economic downturns purged the rottenness from the system. Easy to say when you're a billionaire. By mid-October, A few senators called for investigation into stock manipulation. Bankers laughed. The party raged on. Thursday, October 24th, 1929, the first crack. The market opened strong, then hemorrhaged. 12 million shares traded, triple normal volume. Prices collapsed so fast ticker tapes fell 2 hours behind. Brokers couldn't keep up. Phone lines jammed. Crowds gathered outside the New York Stock Exchange, sensing catastrophe. By noon, the Dow had plunged 11%. Margin calls avalanched across America. Banks demanded immediate payment from borrowers. Sarah Jenkins received a telegram. Deposit $2,000 immediately or shares will be liquidated. She didn't have it. The false hope. At 1:30 p.m., 5 of America's most powerful bankers, including representatives from J.P. Morgan and Chase National, met at 23 Wall Street. They pledged $240 million to buy stocks and stabilize markets. Richard Whitney, the NYSE vice president, marched onto the trading floor and loudly bid for 10,000 shares of U.S. Steel at above market prices. The panic subsided. The Dow clawed back some losses. That evening, President Hoover declared, "The fundamental business of the country is on a sound and prosperous basis." Sarah Jenkins breathed easier. Maybe the worst had passed. It hadn't. Monday, October 28th, 1929, the illusion shatters. Black Monday. 9 million shares traded. The Dow plummeted 13%. No bankers rode to the rescue this time. The pledged $240 million vanished like smoke. Sarah's Chase stock fell from $490 to $320. She was now underwater. Her debt exceeded her assets. The bank seized her shares. 8 years of savings. Gone. Tuesday, October 29th, 1929. Apocalypse. Black Tuesday. Hell unleashed. 16 million shares traded, equivalent to every American adult simultaneously buying or selling stock. The Dow cratered 12%, erasing $14 billion in value, over $200 billion in 2025 dollars. Brokers wept openly on the trading floor. Wealthy men who'd arrived in limousines left on foot, bankrupt. Rumors spread of suicides, though only a handful were confirmed. The legend persisted. Chase National Bank stock fell from $620 to $180, then $50. Depositors panicked, forming lines around blocks to withdraw savings. Banks that had seemed invincible teetered. And Albert Wiggin? His short positions paid off spectacularly. As Chase stock collapsed, he bought back the borrowed shares at rock-bottom prices. Profit, $4 million, equivalent to $70 million today. While America burned, Wiggin retreated to his yacht. Sarah's story multiplied. Sarah Jenkins lost everything. The bank foreclosed on her modest home, bought with a mortgage secured by her now worthless stocks. Her teaching job vanished when Akron schools, facing collapsed tax revenues, fired 40% of staff. At 35, she moved back with her elderly parents, searching for any work. She found none. By 1932, she stood in bread lines, rationing meals, wearing the same worn dress for months. She was one of millions. Farmers watched land their families had worked for generations auctioned for pennies. Factory workers who'd saved for decades saw banks close with the deposits inside, uninsured and irrecoverable. Elderly couples who'd entrusted their retirement to safe bank stocks begged on streets. The populace's nightmare. By 1932, the Dow had fallen 90%, from 381 to 41. Unemployment exploded from 3% to 25%. 13 million Americans, 1 in 4 workers, had no job. Those employed saw wages slash 40 to 60%. Hoovervilles, shanty towns built from scrap metal and cardboard, appeared in every major city. Central Park became a tent city. Families burned corn for heat because it was cheaper than coal. Children went to school hungry, fainting at their desks. Suicide rates jumped 20%. Veterans marched on Washington, demanding early payment of promised bonuses. Hoover ordered the army to disperse them with tear gas and bayonets. America watched its heroes beaten by soldiers. The corporate collapse. Factories shuttered by thousands. General Motors laid off 200,000 workers. U.S. Steel cut production 90%. 9,000 banks failed between 1930 and 1933, wiping out $2.5 billion in deposits. The money simply vanished. No FDIC insurance existed. Corporations that survived slashed dividends, fired employees, and watched stock prices crater. Chase National stock, worth $620 per share at peak, traded for $8 in 1933. Goldman Sachs Trading Corporation, launched at $104, fell to $1.75, a 98% loss. Investors who borrowed to buy at the top owed more than they'd earn in a lifetime. Government's failed response. President Hoover believed in voluntary cooperation and rugged individualism. He urged businesses to maintain wages voluntarily. They didn't. He encouraged charities to feed the hungry. They couldn't. He opposed federal relief as socialism. His Treasury Secretary, Andrew Mellon, advocated letting the Depression run its course. Liquidate labor, liquidate stocks, liquidate farmers, purge the rottenness. The Federal Reserve, instead of flooding the economy with cash, tightened monetary policy, choking off what little economic activity remained. States declared bank holidays as runs spread, but this only deepened panic. By 1932, Hoover had become America's most hated president. Shantytown newspapers were Hoover blankets. Empty pockets turned inside out were Hoover flags. Children sang. Mellon pulled the whistle. Hoover rang the bell. Wall Street gave the signal, and the country went to hell. Enter Ferdinand Pecora. Franklin D. Roosevelt's 1933 inauguration brought new energy, and a Sicilian immigrant lawyer named Ferdinand Pecora. As chief counsel to the Senate Banking Committee, Pecora possessed the prosecutor's instinct and immigrants' distrust of American aristocracy. Starting in January 1933, Pecora hauled Wall Street's elite before Senate committees, broadcast via radio to 60% of American homes. 60 million people listened as he systematically destroyed bankers' reputations. Wiggin on trial. October 1933, Albert Wiggin testified. Pecora was surgical. Mr. Wiggin, you shorted 42,506 shares of Chase stock between September and November 1929, correct? Wiggin, gray-haired and dignified in his three-piece suit, admitted it. And you made approximately $4 million when Chase collapsed? Yes, but I didn't anticipate the crash. You didn't anticipate it, yet you bet millions that your own bank's stock would fall? Silence. While depositors trusted you with their life savings, while your bank urged Americans to buy Chase stock, you were secretly profiting from their losses? Pecora revealed more. Wiggin secreted Canadian corporations designed to dodge taxes. Chase loans totaling $11.8 million to Wiggin's personal firms. The bank lending to its own president to finance bets against itself. Trading accounts with notorious speculator Arthur Cutten, netting another $4 million. America listened, enraged. Newspapers screamed. Banker bets against own bank. Senators received floods of mail. Hang the traitors. They destroyed my family. The injustice. Here's what shocked Americans most. Wiggin faced no criminal charges. None. Short-selling your own company's stock? Legal in 1929. Using family corporations to dodge taxes? Common practice. Insider trading laws didn't exist. Fraud required proving intentional deception. Difficult when Wiggin could claim he advised no one to buy. Public outrage forced Chase's board to demand Wiggin forfeit his $100,000 annual lifetime pension. He agreed, a public relations gesture. He still kept his millions, his mansion, his yachts. He died in 1951, wealthy and comfortable. Sunshine Charlie Mitchell faced tax evasion charges after Pecora exposed his wife's $2.5 million stock dump designed to avoid taxes. He was convicted, fined $1 million, and paid it from his accumulated bonuses. No prison time. He returned to banking in 1935. Other bankers resigned, were fired, faced civil lawsuits. But criminal convictions? Almost none. The laws simply didn't exist. The people's rage. Citizens testified before Pecora's committee, telling stories like Sarah's. Surrounded by bankers who pushed falling stocks, lost everything, abandoned by the institutions they trusted. Widows describe how respectable banks sold them worthless securities. Veterans explain how they'd invested military bonuses in safe investments that vanished. The testimony built unstoppable political pressure. Something had to change. The laws born for betrayal. Pacora's revelations birthed the New Deal's financial reforms, laws that fundamentally reshaped American capitalism. Glass-Steagall Act 1933 separated commercial banking, deposits and loans, from investment banking, stocks and bonds. Never again could Chase push risky securities to depositors. The act created the Federal Deposit Insurance Corporation, FDIC, insuring deposits up to $2,500, now $250,000. Bank runs became history. Securities Act 1933 required full disclosure for stock sales. Companies had to file detailed financial information. Outright lies became criminal, nicknamed truth in securities. Securities Exchange Act 1934 born from Wiggin's betrayal. This act criminalized insider trading and shorting your own company during crises. It created the Securities and Exchange Commission, SEC, to police markets. Pecora was offered the first chairmanship but declined. Banking Act reforms established margin requirements, 50% down payment instead of 10%, banned certain short-selling manipulations, and gave the Federal Reserve tools to control speculation. These laws saved capitalism from itself. Bank failures dropped to near zero. Stock manipulation declined. Ordinary Americans slowly regained trust in markets. The incomplete victory. Yet justice remained elusive. Corporate titans lobbied against the reforms. Glass-Steagall was gradually weakened, then fully repealed in 1999. A decision many blame for the 2008 financial crisis, when banks again gambled with depositors' money. The SEC prosecutes insider trading cases regularly, but the wealthy still often escape with fines that are cost of doing business. The 2008 crisis saw no major bank executives jailed despite widespread fraud. Wiggin's legacy endures. Those who create disasters rarely face consequences equal to the suffering they cause. Modern echoes. Replace Chase stock with cryptocurrency. Replace margin buying with highly leveraged derivatives. Replace Wiggin with executives shorting their own companies before announcing bad news. The patterns repeat. 3 rules for survival. Never invest money you can't afford to lose. Sarah Jenkins borrowed to buy stocks. When they fell, debt destroyed her. Keep emergency savings separate from investments. Diversify ruthlessly. Those who held only bank stocks lost everything. Spread investments across assets, sectors, and geographies. Distrust insiders' public statements. When executives say buy while selling, believe their actions. Public optimism often masks private pessimism. The uncomfortable truth. Albert Wiggin's story teaches a dark lesson. Power protects itself. He retired wealthy while Sarah Jenkins starved. He faced shame, not prison. He lived comfortably while millions suffered. The 1929 crash wasn't caused by one man's greed. It was systemic corruption, regulatory failure, and collective delusion. But Wiggin symbolizes a truth Americans struggle to accept. Those who engineer disasters often profit from them. The laws Pecora championed helped. The FDIC protects depositors. The SEC prosecutes fraud. Glass-Steagall prevented gambling with deposits for 66 years. But vigilance fades. Regulations erode. Greed adapts. And when the next crisis comes, and it will come, we must ask, did we learn from 1929? Or are we doomed to watch another Wiggin sail away on his yacht while America burns? The answer depends on whether we remember Sarah Jenkins as vividly as we remember Albert Wiggin. Her story deserves equal space in history, because for every banker who profits from disaster, there are millions of ordinary people whose dreams become its casualties. What would you do with insider knowledge of crash? Would you warn others, or would you silently profit? The choice reveals not just character, but the thin line between civilization and predation that every society must vigilantly defend.